Okay. Good evening, everyone, and welcome to this installment of the UWI TEDU National Conversation Session on the TNT Economy's Mid-Year Economic Review. The current macroeconomic narrative, as reinforced recently by the central bank commentary, is that growth is slowing due to weaknesses in the non-energy sector. At face value, this appears intuitive, but I want to suggest that this framing may be analytically incomplete. Is what we are observing cyclical slowdown or structural stagnation? These are some of the questions we will unpack in the conversation this evening. Tonight's discussion is going to be similar to the ones that we've had before, dynamic and informative. We've pulled together some of the usual speakers, and I know that they will bring great value to the conversation this evening. We have Dr. Indira Sajwan, we have Dr. Darren Conrad, Dr. Botawari, and Professor Roger Hussein joining us this evening. So without further ado, I'm going to allow Dr. Sajwan to share her presentation and she can get into the discussions. Dr. Sajwan, go ahead.
Thank you, Rebecca. Are you hearing the notifications on my phone? I think I need to power off my phone.
No, we are not hearing it.
Hi?
Hi, Dr. Sajwan, you can go ahead and share your presentation.
Sure. Okay, good. Sure. There we go. Here we go. Okay, give me a minute. Thank you very much, Rebecca. Let me just clear some things off of my screen so I could properly see. Let me go for it. Good. Thank you very much, Rebecca. I want to start off by saying that this session today is named mid-year review. Mid-year review, as we have all come to know, to understand it, means a budget is read and we come together midway once the government does its mid-year review and we have an analysis of it. So there is that. It is about that time. Budget read in October. We really are about that time. But what is also interesting about now is that we have a new government that really took office in April of next year, so that it is very difficult to just to analyze where the economy is right now under this new administration, but without maybe taking a little bit more of a broader view and looking at the entire period, not just restricting it to this period. Now, the world, this is what the world that we live in today looks like. It is what experts are calling a polycrisis. It's crisis upon crisis. And it's almost as if every morning we wake up, there is something else that we have to deal with and contend with, all of which kind of stuck on top of each other, which makes the ability of small island states like ours, our capacity to be able to respond, to be able to survive in this environment more and more difficult. I mean, no one expected, we thought the world was finally kind of in a good place. Global growth, we were projecting about 3.3%. Inflation seemed to have been holding sturdy and low. We weren't expecting interest rates increases because things were looking quite good. And then the war broke out between the United States, Iran, and Israel. And of course, we all know now what has happened since then. We are now hearing about the UAE pulling out of OPEC. There are implications for that with respect to the supply of oil, with respect to the price of oil. So, and another thing is almost as if like I say every Monday morning. Now, when we look at the economy that is Trinidad and Tobago, and we try to analyze how this new government has performed, we could do many things. There are very many ways we can analyze it. We could say, how have they done with respect to foreign policy? How have they done with respect to crime? How have they done with respect to social, maintaining social coherence in the society? And one has to decide, given the limitation of time, what one wants to focus in on. I am focusing on how the government has performed from an economic perspective in terms of managing the economy, managing the economics of the economy, and what has really happened. And I wanted from the onset say I feel that the government deserves, whether we talk mid-year review or we talk about 1 year review, I think the government deserves more than a passing grade for having spent this period stabilizing the ship, as it were, ensuring that the slide that we were seeing quite visible in the period before didn't continue to proliferate. And I think for that they deserve more than a passing grade. I will try in the time that is allotted to me to use data in order to try to support that argument. It is not all comprehensive, and the areas that I would have left out, there are areas where they may not have performed very well. And obviously we can discuss all of those things in the question and answer session. Now, what did the government inherit when it came into office? And I think this paints a very graphic picture of where the economy was when the new administration came into power. I want to use my cursor. It was a situation where the overall fiscal balance was negative over the period. It was in the most recent period before they came into office. It was net minus 8.7. The current account balance was negative. The non-energy fiscal deficit was minus 24.7. Primary balance was minus 2.0. The non-energy primary balance was minus 18%. And from a overall perspective over the period 2017-18 to 2025, when we look at the graph towards the right, we will see that total revenue, with the exception of 2022, and we know what happened in 2022, the war in Russia, Ukraine, which gave us a positive blip in terms of our energy revenues because of the increased prices of oil. Revenues have continued to be lower than expenditure. We've continued to realize deficit over this period of time. And this is the environment that the economy that the new government inherited. It inherited one where there really wasn't money. There was a foreign exchange crisis. It wasn't employing and jobs. And as we all know, the former Prime Minister is on record for saying if Dragon didn't come true, our cuckoo cook. Basically, there was not much else on offer that could take us out of the conundrum that the economy of Trinidad and Tobago was. So 1 year into the game, what has happened? And the data coming out of this is data that comes out from the central bank, shows that between the period October 2025, which is when the budget would have been read, to January 2026, the government actually enjoyed a fiscal surplus of 126 million. Now, the thing about it is it is good, but it doesn't necessarily sing a very healthy song, because on both counts of revenue and expenditure, we saw contraction. So the projected revenue over this period was not realized, but the expenditure that was projected actually fell short. So the government didn't spend as much as it intended. It didn't receive as much as it had projected, but overall, the situation was a surplus situation. The public debt, though, has increased from September 2028 to February 2026. It has moved from 84% to 84.9%. And I think moving forward, certainly over the next 2 years, we can have an expectation that this public debt situation is going to worsen even more, because government simply does not have the fiscal space through revenue generation or through its capacity to be able to raise money in any alternative manner, and therefore we are going to see this continuing to raise. We are going to see potentially increased withdrawals from the HSF in order to maintain the expenditure levels. I know some have argued, well, maybe the government should have cut expenditure. But how do you shock an economy that has been operating basically on an expenditure pattern of close to $60 billion, where the government, especially over the last 10 years, has in fact been the major spender in the economy, especially in face of the significant contraction in the energy sector, and even and not and maybe all right, but not great performance of the non-energy sector. How do you shock a system to engage in a significant contraction in expenditure? So the new government kept along the same line, presented us with an expenditure package of close to 59 point something billion dollars, keeping in line with the same pattern so that the economy isn't shocked, because again, the same way the multiplier grows to applies to grow the economy by a factor of whether it is 1.2 or 3 or whatever it is, it could also work in the reverse. So a significant withdrawal of expenditure from the system by the government would have resulted in a even worse contraction of the economy. And I think the government was very minded in that regard, and therefore they sought to maintain the expenditure package. Now, look at this particular table here, and it shows the quarterly index of economic activity year on year by the percentage change. And over the period 2023, fourth quarter of 2023 to the third quarter of 2025. And what we will see, and I want us really to focus on the period under this particular administration, which would have been like, what, about towards the end of the first quarter of 2025 onward. We saw some positive movement in the energy sector, which is shown by the darker brown. But look at what has been happening with respect to the non-energy sector. Growth in the non-energy sector has been negative. And in fact, I have data for the last quarter of 2025. That's the most recent data I have been able to access. And the non-energy sector, it contracted by a minus 1.2%, a further contraction. I don't have the figure for the energy sector. I thought it was important to go a step further. And the data here for overall for energy and non-energy really is what we just saw in the table. But I thought it is important to look at the non-energy sector, because as you all know, I am a strong advocate for non-energy diversification. I believe in it very, very strongly. But look at what has been happening to the non-energy sector over the period fourth quarter 2023 to, let me just move this, to the third quarter of 2025. It really has not been performing under well, the subsectors within it. Look at construction, which is one of the sectors that we look at, especially when we want to see if things are turning around. From the first quarter of 2025 to the third quarter of 2025, we have seen some significant contraction in the construction industry. And this has to do with the fact that we're not seeing major projects coming in through the government. There's been very minimal private sector activity in the construction field, and a lot of it has to do with payments owing to the contractors that's still to be paid by government. As government has not been able to move the radar in a positive direction with respect to that. Manufacturing, excluding refining and petrochemical as well, in the period over this in the new government, has not been performing very well. We've seen some marginal growth, but for the most, look at the second quarter, minus 3.6%. Wholesale and retail, again, some contraction there, which I guess we could link quite heavily to the overall decline in the economy in terms of people not having the kind of spending power they used to, as well as the Forex crisis that has put less and less money in the hands of this sector that really is a user of foreign exchange, not an earner of foreign exchange. And agriculture, again, continues to be performing not so well. But look at the years before, the contractions were much more than we are seeing in this new period. And it suggests, therefore, that something positively might be happening in agriculture. When we look at capacity utilization within manufacturing, we're seeing that the kingpin here obviously is food, beverage, and tobacco, where in the 3 quarters of 2025, we've seen it's moved to, quite a significant amount, just short of 20% to full capacity, but in areas such as chemical products and what is referred to as other manufacturing sectors, not so healthy. So the manufacturing, non-energy manufacturing sector is one that we want to see more growth taking place, and that has been significantly constricted in terms of its growth. In terms of the monetary sector, I brought this graph in really for us to focus in what has been happening with business loans, which is this particular line item here. Could somebody confirm that you're hearing me, that all is well with my
Yes,
presentation?
I'm hearing you.
Good.
Hearing
Right.
him.
So it is this particular line item, this line here. And you will see that it has basically been flat since 2023 to October 2025. Now, we need growth. We need businesses to be borrowing for investment. There's been contraction, and I have some more recent data that I want to just tell you about. Between October 2025 and February 2026, and that is from the reading of the government's budget to now, overall private sector credit has moved from 6.3% to 5.3%. So there's been a decline in private sector borrowing and overall. And within this, borrowing for business loans has contracted somewhat from 6.8% to 6.6%. Real estate mortgage from 5.8 to 4.7. Consumer borrowing has moved from 8% to 5.6%. Very interesting, I think, the contraction in consumer and borrowing for consumption purposes. And, that is something I think we need to drill down and try to understand what is happening there as well, because as we all know, supply is a derived curve. We need consumption to be happening for there to be the incentive for investment to take place, certainly in our domestic space. So these are figures that continues to be concerning under the new administration. They have continued to decline, and it is something going forward that the government must pay attention to and must identify what needs to be done in order to be able to turn around what is happening, particularly with respect to business loans. So I just thought it would be useful just to present this, to show what's been happening with the stock market. That the stock market in Trinidad and Tobago has really long been, and the decline, I think, predates the data that I have. But it seems to be an area that we simply cannot get to grow. And the stock market, as we all know, is an important market for raising capital, for listing business, for growing business. And some more recent detail that I have says, and I think I have the next graph, says it. Yes, so the stock market, it's dominated by financial services and by the conglomerate sector. And we know that the conglomerate sector is by and large mostly a wholesale and distribution and retail sector. So that should concern us, because we really want the stock market to be dominated by manufacturing companies that are not just manufacturing to sell to us locally, but manufacturing in order to be able to export. But this is how the stock market is characterized. And in March of 2026, the most recent data, the trading that took place was, again, it remained within these two sectors, 39.6%, financial conglomerate 38%. I then thought, let us see what's happening with respect to the external sector, investment and gross external debt. And look at the picture. Investment, international investment, the light blue figure, is very worrisome when you compare it to the basically flat, not decreasing, darker blue columns that represent gross external debt position. Now, but this by and large is what this government has inherited. It has inherited a situation where both domestic and external debt is potentially at a maximum. There's very little room that the government has to raise money to be able to spend. So it is managing a situation that is very, very difficult. And I think deserves kudos that 6 months into the game, we are seeing, even though it comes with reduced revenue and reduced expenditure, we are seeing that the Minister of Finance has been able to hold things stable. And I think that this particular net official reserve is some good news. It's some good news because, it hasn't collapsed on us. We know that our propensity to import is extremely high. We know that there are points in time when we're extremely concerned about our net official reserves because the number of months coverage tends to be going down. But as of February 2026, we had over 6 months cover with respect to our net official reserves. And basically, you see, from December 24, it was going down, going up. But clearly, from October 2025, the government has been able to stem the downward slide, and it is on an upward trajectory. Some more recent data I can share with you. When you compare March 2026 to March 2025, the net official reserve is March 2026, approximately $5.4 billion as compared to $5.3 billion for March 2025. I think the new administration deserves credit for being able to manage. Maybe it's not been managed in a way that everybody's happy. I know the manufacturing sector, non-energy manufacturing sector, for example, has been bemoaning the fact that their access to foreign exchange is quite hindered and they need it. But sometimes necessity is the mother of all. And I think that in the face of shortages, I have heard some creative mechanisms being used by the non-energy manufacturing sector. One company, case in point, has said that while the domestic market is quite significant for them, because of the forex crisis and they're not being able to access foreign exchange, what they have sought to do is that they have in fact sought to shift supply from the domestic market to the export market. So that's the non-energy manufacturing sector is finding creative ways in order to be able to deal with this. I thought it would be useful to provide with respect to the forex market. I know that it does remain a challenge. It is a situation where demand continues to outstrip supply. But, again, I should say, which I should have said at the beginning, please note that I am here in my capacity as Indira Sajju, an economist. The views I express here, the analysis, is that of my own, not that of the Central Bank of Trinidad and Tobago. Although, speaking gently, I would say that much is being done in order to manage this situation. But look at where the demand is. And I think it is important if we want to do better at managing the economy going forward, we need to understand these things. One, the energy sector remains the main supplier of foreign exchange. 70% of what goes to dealers in the private sector comes from the energy sector. Within the last few months, this was significantly challenged because the energy sector was not converting US in order to meet their bills, but they were using VAT bonds that had come due, so they were using TT dollars mostly. That created quite a significant challenge to the supply of foreign exchange. But when we look at the demand for foreign exchange, we see to satisfy credit cards, 41.6%. Now, I think it is worth our while, Roger, to find a mechanism to really drill down on this credit card. What comprises it? Because we see credit card usage and everybody jumps on the consumer public, those of us who buy online, buy from Amazon, etc. But I think quite a chunk of that is business use of credit cards. And I think it would be very useful if we could kind of deconstruct that. Retail and distribution, almost 25%. That a user of foreign exchange does not earn foreign exchange. Energy companies are about 10%. I'm not sure which are the energy companies. The automotive companies, 7% goes to this sector where we import vehicles, and this is not a sector that earns foreign exchange. So, I would say in terms of this, I think, kind of puts us in terms of where we are. The IMF, as we all know, is projecting positive growth for 2026 and stronger growth in the 2027, 2028. Debt to GDP, they have it at 84%. It's already at 84.9%, anticipated to grow heavier. They see in the short term, it is the non-energy sector that could give us the growth, but we are seeing that the non-energy sector is not performing as we would want it. They expect the medium-term growth to come from the energy sector, but the long term is one where we absolutely need to balance it. Now, I have provided this graph just to say in terms of the outlook, it looks very positive for us to consider that we could potentially, certainly 2028 and beyond, looking at another energy boom for Trinidad and Tobago. We are currently at about 2,700 BCF per day. What we ideally need is 4,200, but that's with full utilization of all our infrastructure, including some plants that have actually been shut down, which really will bring down that figure in terms of what we need to bring the industry back up to capacity. There is the anticipation that second half of 2027, 28, with the coming on stream of Manatee, we could be at about 3,400. I've put Dragon in red, even though there seem to be a lot of positives coming out from the energy sector with respect to Dragon. Let's keep it in red. For now, there is the Exxon deal. And I think this government needs significant credit for the speed at which it has action initiatives in the energy sector, because we all understand that this economy continues to be heavily reliant on the energy sector. If we could get this going again, we can shore up government's revenue situation. We can bring a lot more foreign exchange into the system. We can, so there's a lot of rents that will additional monies that will come in, employment generation, etc. I think though we need to caution the new government not to become complacent when this starts to happen post in second half of 2027 going forward, that they lose sight of the fact that this is not sustainable in the long term. And if they are minded to have the best interest of Trinidad and Tobago at heart, then we must of necessity focus on the issue of non-energy diversification, manufacturing, tourism, agriculture. We're seeing some positive signals in the tourism sector. We need to strengthen this. We need to grow it. Same thing, manufacturing is suffering right now. The slowdown comes from foreign exchange pressures, cost pressures. There is the anticipation that as the energy sector recover, manufacturing will recover. But we don't just want the traditional manufacturing that has a high reliance on foreign exchange earning to be the sector that now starts to grow again. We have to look at diversifying our source of foreign exchange through a lot more meaningful manner. We need, similar to what we see with respect to the revitalization plan in terms of the grand presentation, we need a grand presentation of a diversification plan that shows us what agriculture should look like in 5 years, what tourism should look like, what manufacturing should look like, what all the subsectors of tourism, etc., should look like. And that hand in hand with the revitalization project, I think would, if we keep at it in the same way that we've gone under after energy, I think we could potentially looking at sustainable long-term growth for Trinidad and Tobago. We must accept the fact that we're not generating jobs for our young people. We have heavy brain drain. We're not generating enough forex. Our agricultural sector needs a lot of work. Tourism, all of these sectors need a significant more amount of work than is currently being put on the cards. It is concerning to me that the government came into power and, we heard a lot about non-energy diversification, and I want to suggest that that has slowed down significantly. Many, many very ambitious targets laid out within the budget. We are now 1 year in, and we are not seeing any signs of how these targets are going to be realized. I know I'm out of time, so I'm not going to go into it. We can go into it in the question and answer session. I do want to just end on the note that I see that the Marriott has just gotten their EMA certificate in order to move forward with that project. That is very important for Tobago, and Tobago needs to deal with its high-end room stock if it is to be able to fill the planes that it wants to fill when the new airport opens, if it wants to start to contribute in a much more significant way to the issue of tourism for Trinidad and Tobago. So I'll stop here. There's a lot more I could say, but in the interest of time, I think this is what I want to offer as a first round, and I'll take questions and we can have a conversation. Thank you.
Thank you very much, Dr. Sadron, for giving us that context and some of those details. I will hand over directly now to Dr. Conrad to present his discussion. Dr. Conrad, go ahead.
Hi, Rebecca. Good evening, everyone. Thank you to Tidu and thank you to the Tidu team for providing me the opportunity to present. And thank you to Indira for presenting such a rich profile in terms of the status of the country and all of the indicators that you would have captured. Let me quickly share my slides here. Wait, what am I sharing? Rebecca, do I have the privilege to share?
Yes, Dr. Conrad, you do. You're a host.
Okay. All right, there we go. All right. Right, so you can see that, right? No, I can't see myself.
Yes, go ahead.
Yes,
All right, okay.
we are seeing.
Okay, great. So essentially, what I wanted to point out is that Indira highlighted all of the key economic indicators, and they all seem to be in the sort of the range where we want them to be. However, I mean, to be honest, based on what we are seeing in terms of the most recent data pack coming out of the central bank, as well as the IMF Article 4 review, which I think that was conducted early in January into February, late January into February, everything seems to be in the zone of sort of stability. However, I mean, it makes us sort of the enviable island in the Caribbean region. However, so I did say that we have the global context. I think Indira highlighted that is that it's a very fragile environment. In particular, I use this word fragile. I went back a couple of years back to an IMF statement, and it continues that the global environment continues to be very fragile. And that is one of the things that we're noting, and it seems to be becoming more and more fragile as the weeks wear on. As a matter of fact, the Brookings in the United States, oil prices have topped out $4, and apparently, well, Brookings Institute this morning indicated that if the war were to continue into next week, it would top out at $5, and that price, even if the war ended, that price would stick around until somewhat time in September. So we're looking at a significant increase in movement of goods via transportation costs and movement of people via airfares, because airfares have already increased significantly. So things seem to be very, very fragile in terms of the global economic outlook. With that said, I do believe that our positive indicators and our positive position in terms of where the economy is, I do believe that it is one that is considered to be, I'll go straight to it, is considered to be quite fragile. It's stable, but it's a fragile kind of stability, and it's a very soft stability, meaning that I don't think there's any room for any shock. There's been a significant improvement, and I must say that I don't speak to any side. I'm politically neutral, so I don't speak to any side, and I don't speak to any particular policy any side would have taken. But I do speak to what policies are on the table and how it would affect the economic situation moving forward. So Indira mentioned some of these, but the one that I drew my attention in amidst this fragile stability is that there was a reduction, a contraction in retail sales in the third quarter of 2025, and that contraction continues. And that to me is a little bit worrisome. And I think that is the reason that we're basking in very low levels of inflation, is because of a significant contraction in demand. Now, low retail sales tells me a lot of things, is that households are not spending. Either they're not spending because they don't have, or they're being very cautious and they're not very optimistic about and they're not very confident about the future position of the economy. So that is something that we need to be mindful of. With that said, I wonder to what extent these new proposed taxes or these new taxes in terms of the ones on landlords and so on, to what extent that would even cool the demand on retail sales even more. And if that demand, that retail sales continues to cool, it means that we will see pretty much a contraction in this quarter overall in terms of the economic performance, because that demand is not driving, it's not the fuel that we're not going to see it as a driver in terms of the economic growth of Trinidad and Tobago. So we're more so of in a holding pattern, really a holding pattern. When we're just barely stable, and it's not to be considered even a deep, broad recovery. I won't even consider it. I think consider this just a sort of a very, as I said, a very fragile stability, and something that we should be happy about nonetheless, but not something that we should be dancing in the streets about, primarily because it's there's a lot that's riding on this. Now, cement, as Indira would have mentioned, the contraction in the construction sector, and that saw a fall off in the demand and the sales of cement by 92,000 tons. So, and of course, the fall off in the retail sales includes that of the supermarket groceries as well. So that to me says that we're not really enjoying strong consumers, not enjoying broad consumer strength in terms of where the economy is. People are spending, but cautiously, not really in a way that would have any expansionary effect. So we need to be very careful. As I said, the seemingly bright spot is the low inflation, but my question is that low inflation as a result of the dampened demand? Now, of course, the labor force, the data is always a little bit dated because they don't have recent data for the labor force. We have a very small labor force, but employment stayed, it was pretty much steady, the 4.8% that Indira had presented. And I do think that the participation rate continues to be a source of concern, although it's not something that I would necessarily opine on, because in some academic writings, it indicated that low labor force participation rate is not really a cause for concern, pretty much like the debt to GDP ratio. IDB, in much of its writings, indicated that a debt to GDP ratio increasing above 62 is not really a cause for concern. It's not something we should be alarmed about, pay attention to, but not be alarmed about. I do think that from a monetary standpoint also, that the economy maintains stable in terms of the repo rates and so on. So we again, something to be grateful about. Now, of course, it would be remiss of me if I didn't mention the labor market, given that today's May Day, right? Of course, we have the saturation rates in the various sectors. I would have presented this in other areas. So that tells us that we don't really have room for expansion in some of these areas, but we do have room in construction. We do have lots of room in agriculture. There's a lot of potential there. And know that we have comparative advantage in trade and repairs. So that is something that ought to be explored as well. There's a lot of opportunities there that can be explored. So what I think that should happen now is that, given we have this sort of gentle stability, it would give us now the breathing space to sort of look at the areas where there is potential for short-term, medium-term, and long-term growth in that order. I think it gives us that space now to really evaluate that and move forward with those considerations in mind, so that we would be able to enjoy, moving forward, a more stable platform that we can grow from. I won't take up too much time because I know we're trying to hit that 8 o'clock mark. Now, I do always maintain that we have capacity in certain areas that we know that we should be looking at leveraging. And that, of course, would be the human capital. Mobilizing the human capital is something that I always advocate for, because we do have a large human capital base. If we don't mobilize them, pretty soon we'll begin to lose them to other countries that may be growing, not necessarily North America, but there are other countries that would absorb the human capital to continue their growth trajectory. So we should be finding a way to mobilize that. continue to work with and leverage the financial services sector. Again, Indira mentioned that there's a fall off in investment borrowing that could be as a result of the lack of optimism about the future. And of course, we know our commercial banking system is very much risk averse. So if they're not optimistic about the future, it becomes even more difficult for small businesses and small and medium businesses to secure loans, because the bank will also go into that more risk averse mode. And of course, trade and repairs is where we have a lot of capacity so that we can leverage that. So those are some areas that we can leverage in the short order to generate some growth. This I borrowed from Professor Hussein's student, Mark Rupchan, where identified some areas for export potential. And as Professor Hussein and Mark Rupchan study. And this is just a snippet of one of the tables, which I thought would be useful to not just to see what are the opportunities, but also to highlight the type of work that the students in the department undertake at the postgraduate level under the supervision of Professor Hussein. And of course, we do have our ongoing fiscal challenges. Now, while I do acknowledge the fact that the government has undertaken some fiscal consolidation, I think the pace is a little bit too slow. We don't have fiscal buffers. We have very little fiscal space. Yes, I mentioned there's no benchmark for debt to GDP ratio, but we need to be mindful and keep an eye on it. We still continue along with the same transfers and subsidies, and I don't know how long we will be able to continue with that. That generates no movement in the economy. That's pretty much a handout that really does not really generate. It keeps people sort of roofs over people's head and food in their bellies, but in terms of meaningful economic activity, maybe there should be some thought in terms of how long persons would be on subsidies for, and how long we would be able to take them into the future, or divert some of those resources into some of the much needed activities that would create a more stable macroeconomic environment where they can then get meaningful jobs. And of course, we continue with now I do think that what can be repaired, and I mentioned this in another space, in another presentation, that our tax collection mechanism needs to be refined, and because we're hemorrhaging quite a bit. And I worry that even with the implementation of these new measures, with the hemorrhaging still taking place, will it really generate the type of revenue that the government thinks it would generate? And while I'm on that, there's we talk about expanding the tax base, but there's a lot of missed opportunities for taxation. We have a lot of vendors operating on the street, generating substantial income, not even paying a license to operate other than the free health badge, food badge they call it. And they pay no license to operate, and they pay no taxes on the income that they earn. So we need to consider some way of at least charging a license, operator's license for them to generate something, and have them file taxes just like everybody else. I know that one will get me in trouble, but I think it must be said at some point in time, because we have too many people walking around earning substantial revenue and not paying their fair share of taxes, and others carry the burden. And I think that is where I will stop. I said again, mobilize human capital, continue to maintain the stable macro environment. That's important. Maintaining this macro environment. That means paying very close attention to what goes on in the global arena, and then having the concomitant measures put in place here to sort of insulate us against any shocks from those things. And I'll stop right there, recognizing time. Thank you, Tito, and thank you everyone for your time.
Thank you, Dr. Conrad. Dr. Tawari, go ahead, straight into your discussion.
Okay, can you hear me?
Yes, we can hear you.
All right, okay. Thanks for those two presentations. They were both very good and complimentary. And thanks to Tedu for giving me this opportunity. I know we have a short time. I'll just try to make a few points. Indira talked about what the UNC government inherited. And we all know the facts show, the data shows that it was not very good. They have now come through a year politically, but only half a year in fiscal terms for the budget. And we sense from all the reports, whether central bank or World Bank, that you have growth around 0.2, 0.7. The World Bank optimistically says maybe 3.2. Everything is dependent on energy, and the rest of the economy is really has no energy, if you want to call it that. The rest of the economy really is without any kind of thrust forward. So you have this pending windfall or boom, let's say 2028 to be cautious. And we are now in 2026. You hear midterm review, you have 2027, you have 2028. You will do the mid-year review now. You have a budget in September 2027. You have a budget in September 2027 for 2028. And really, I think the government would do well to see this as a packaged period of opportunity to prepare for the boom. Because if we don't prepare for it, the money will come and it will go into expenditure and debt that we incur now. And it will pass through the country, as Manley once said in Jamaica in the 1970s, like a dose of salts again. So there are things that we need to do in the interim between now, whether it's in the review, whether it is in the September 2026 budget, whether it's in the September 2027 budget, that allows us, since we know that that is coming and there is an anticipation, to really take advantage of that. So a lot depends on what we do in the next 18 to 24 months as we wait for the increased flows of natural gas. And I think that that is where the government might spend a lot of its time. Also, the way we are making policy and doing things, we need to be cautious about it. Because if we do things in the same way, we are not going to get anywhere different. For instance, if we create 15,000 jobs in the public sector, that is part of recurrent expenditure. It becomes consolidated and permanent in the system. And that is already, recurrent expenditure is already 93% of the budget. If we are building homes, and we need the homes and we need the construction jobs, we cannot have the state build it because it's too costly. And it is taxpayers' money. We have to have the private sector put their money. The state has no money. It will have to borrow to do that. So if we're doing housing, it has to be private sector-led construction. And we must understand that it's going to be for a foreign exchange drainage on the country as well. So we need to take that into account. If you increase police posts, that might make people feel better. It might make more police visible, but it's an expenditure. And if you are moving away from makeshift jobs to more fulfilling long-term jobs, you have to make sure that those are in the private sector, not the public sector. And the only way you can do that by shifting the structural balance economically to private sector investment in the country and to make a difference in terms of sustainable jobs. So let us look at some of the things the central bank says and some of the things the World Bank says. When they on the positive side, the central bank says that we kind of in a holding position. Darren mentioned that. And the economy is not collapsing, but it is not about to lift off either. But why is this so? Because of the forex stranglehold and this import trap, because of the productivity crisis, because you have low value employment and skills mismatch, because of cheap inputs like gas and electricity into production, which have now been lost by the manufacturing sector. And therefore, their competitive capacity and their export potential is now affected. There's also an innovation lag. You have no innovation in local industry. The state is just too large. It is unmanageable. It is crowding out the private sector. And the ease of doing business bureaucracy, I mean, all of us are fed up talking about that. And it is not happening. And the bank policy is risk averse because they would rather lend for cars than to lend for a business. So this summary position based on the central bank assessment is that the economy can be described as resilient, but it is static. The buffer we have from energy keeps the floor from collapsing, but there is no existing private sector engine that can cause the economy to grow. There is no growth platform structured in the Trinidad and Tobago economy when energy fails. That is the reality. Okay? So what does the World Bank say? The World Bank says that the energy projects in train can provide the funding for serious development. Okay? And it is anticipating 3.2 next year. So I don't think that will happen, but still, they sense that there might be some cause for optimism. They say, however, that structural reforms are the fundamental building blocks, an essential foundation to give energy funding a multiplier effect when it arrives. In other words, you can't just wait for the boom. You have to do something before it comes here that will make a difference to the boom itself. And the World Bank makes it clear that without that necessary foundation, Trinidad and Tobago will be trapped in another hopeless cycle of what they call, and I quote from them, commodity-dependent volatility. So, I mean, do we want to go there again? We have had booms and busts from 1962 to from 1962 to 2014, really, because we carry in that through. And we've had all of these, and when we get the bust, we cannot recover. And when we get the boom, we do not recover. We recover temporarily. And then the boom goes, and we are back to square one again. So what do we need to do? The World Bank says to shift to agriculture and creative economy. Indira would agree with that because it makes sense with the tourism. To shift within the energy domain, though, they say that. They say instead of just exporting raw molecules, shift to advanced petrochemicals or green hydrogen. Well, we have a hydrogen project. They say strategically address the informal sector. Darren was just talking about that and the taxes, etc. But that is certainly something to deal with. They say focus on trade logistics like ports and custom that are killing SMEs, and redirect education to things like AI and tech services and green tech. The whole university and tertiary system is really irrelevant to the changes that are taking place in the world now. And we've got to find a way of aligning education strategy to the kind of economy we have to create. And they say use Trinidad and Tobago's location as a safe harbor in the hurricane belt to build digital capacity for digital infrastructure. Okay, and we always talk about the quick wins, whether it is Roger, whether it is Indira, whether it is Conrad. They talk about tourism based on natural assets, the agriculture value chain, and manufacturing now needs to be AI driven and so on. So based on those assessments, what do we need to do? And right now in Trinidad and Tobago, we need to restructure the economy, to shift the balance to private sector, foreign exchange, earning capacity. And also, we must swiftly roll out artificial intelligence pathway to the digital economy, which will make Trinidad and Tobago much more efficient, effective, competitive. It will enhance our economic relations with CARICOM because of the digital connectivity. It will locate us more productively higher up the global value chain because of the global value chain itself and the role of technology in this. And if we do this in the next 18 months, deal with the structural shift to private sector investment and export-oriented action, and go to the digital economy by taking advantage of the opportunities we have. And I know we can do this if we are prepared to lift the country beyond partisan politics and do this, then I feel that we can get there. But I have to say something about the politics. We have to change the politics too. I mean, we cannot govern as a government in a way that always is dominant in its consideration of the politics. And the PNM as an opposition is really quite horrible these days about the way it is playing the role of the opposition. And I know that there's a battle for power, but there's a battle for survival for the country. And we have this anticipated revenue coming here, and we have 2.5 years to do it. And are we going to end up in a situation there where we are going to have another boom and bust, or are we going to do something for the country and its people in a serious way that smacks of sustainability? Because if we go on 2% growth here, 3% growth here, etc., we are not going to make it. We have 18% to make up simply from the declines of the decades under the PNM. So that will simply get us to where we were. So incremental growth is really not a good option for Trinidad and Tobago. It might feel nice and it might look good on paper, but it's not going to make that much difference. And it's not going to get us the platform that will secure the funding that we will get from the energy sector in 2028. Because we have to leapfrog. And how do you do that and make a difference? Well, we could do it in agriculture, we could do it in manufacturing, we could do it in tourism. That is true. But we need to get the digital stack going. We negotiated with India, we signed some agreements with them. They gave us a digital stack. They are willing to roll it out. And the government is doing well in some ways. They did the sod turning for a hotel in South the other day. They began to roll out verified TT. But this is happening too slow. It needs to happen much faster. And we need to do this for our survival. And I want to stress that. It is really our survival and the difference it will make between another boom and bust cycle. There are 3 main floors in the digital house that we have to build. We have to build an identity block, a money block, and a memory block. Okay? The identity block simply means a digital ID, which is a kind of super ID card that is installed and lives on your phone. What is the value of that? It means that next time you go and they ask you for your birth certificate, your passport, and utility bill, you will remember that you don't need it anymore because your digital ID will make all of that unnecessary. So the digital ID is a super key that allows you by fingerprint or code to identify who you really are and get your business done. Then you need the money block, which is the second floor in the digital stack. And this is not foreigner. This is what India is prepared to give to us, and they do it already. And that is for fast payments. A fast payment system makes money move like a text or a WhatsApp message. Money moves from one phone to another in 1 second at no cost. And the memory block is the data sharing flow. All your information is in the right places, and you know that, but with your permission and your ID, information can be shared. Health information can go to the hospital. Financial verification from the bank can go to a business. Other documents can be moved from place to place, but everyone has to be connected. And these three components called the digital stack, some people call it a magic stack, because when a country installs all three stacks effectively, identity, money, and memory, then something amazing happens. You can now start a business in 5 minutes instead of 5 months. Your grandmother can get pension on the phone instead of waiting for the mail or standing in the hot sun. A digital ID and a payment block will allow any 20-year-old that you know to start a global business, have the trust of customers anywhere in the world, and get paid in Forex. The problem is that we have been viewing the digital stack as a tech project from top down. That is why we can't get it right for 20 years. 20 years now we're trying. Remember Dr. Rowley's talk of a unique identifier? Remember the People's Partnership attempt at health identification and social services identification? Remember we had a whole ministry for digitization in 2020? And we now have one for AI. Remember Singapore was here to assist, and so was Estonia recently. But instead of seeing it as a tech project, let us see it as the most effective way for unleashing a country's hidden wealth, a kind of flow economy where ideas and money move instantly. Those who know about these things argue that effective use of the digital stack can make an entire country grow richer and faster. Global data from India and from World Bank sources show that a country with a strong digital stack can see its national economic speed up by 33%. It is incredible to believe, but studies do claim that. Some have made the analogy that it is like adding an extra lane to a highway that was always jammed. In Trinidad and Tobago, you can use the stack to formalize the informal economy. Some years ago, Dr. Sandra Sukram, now head of the ISCR, did an assessment of the informal economy in Trinidad. It is quite significant. People with cash-only business or cash-only jobs can be brought into the formal system through the technology. You would then increase the tax base without raising taxes, simply because you now have more transactions, they are now more visible, they are recorded. Experience has shown that the digital stack reduces costs. Banking costs, which all of us are seeing now are going up, for instance, can come down. When money moves via a public digital system, the fees that credit card make, which is about 2 or 3%, is eliminated altogether. The digital stack creates a space where anyone with an idea or product can compete globally. Now, India has signed an agreement with Trinidad and Tobago. They have signed an agreement with CARICOM. This digital thing is waiting. We could make it happen. We have begun to roll it out. The key thing about these digital stack is interoperability. So that if we were doing something based on the Estonian system, and we are now doing something based on the Indian system, they can be made to be interoperable. And the question is, can we do it? Yes, we can do it. The digital stack has been provided by India. It is ready to go. The Minister of AI went to a major AI conference in Delhi to support countries of the South. What we need is trust and the technological connectivity. Trinidad and Tobago's technical foundation is surprisingly strong, and we have already begun the process, as I have mentioned. We just rolled out 2 weeks ago Verified TT. It is the beginning, but it is not enough, and we need to go faster. Trinidad and Tobago, it might surprise you, has a high performance infrastructure. In terms of internet penetration, 84% of the population is online, according to 2025 data. This is higher than the global average, and it puts us in a good place for digital services. There are more mobile connections in Trinidad and Tobago than the size of the population in TT. Samsung and Apple control 90% of the market. What this means is that almost everyone carries a high-level digital stack receiver in their pocket, their mobile phone. 28% of our population is under 25. That is about 400,000 youngsters. This is comparatively small, but not insignificant for a small country like ours. This is a digital native population that does not need to learn how to use the stack. They know it already. They are just waiting for the government to roll out the system so that they can stop filling out forms and paper. One of our other worries is the 13% population that is over 65. But the technology is not daunting to them either. It is enabling. They don't have to write a code to go digital. All they need to do is to tap their phone at the grocery counter. The evidence shows that in states that have gone digital, the highest adoption rates for digital IDs come from the elderly. Why? Because it solves two big problems that they always have: physical mobility and having to line up. Digitization does well in small states. Singapore is a leader. Estonia is a leader. Togo in Africa is doing well. Barbados and Jamaica are getting on board. With the India stack, we are very well positioned in Trinidad and Tobago, and we can achieve a significant amount of digital sovereignty, not just for Trinidad and Tobago, but the region. Size can be a powerful factor in digital matters. A small country can win autonomy and become a kind of little superpower because it builds a platform for agility. It took India 10 years to enroll 1.4 billion people in a digital stack. With political will and purposefulness, we in Trinidad and Tobago can connect 1.4 million people in 12 months with dedicated effort. The big problem is skepticism and privacy concerns, and there are ways of doing that. You have to have basic rules that deal with that. I will stop now because I don't want to go on. I don't want to cut into the rest of the time, but I just want to emphasize these three things. You might have had a bad inheritance, but the point is that you are now in government and you have to govern. Secondly, you know that the boom is coming in 2028. You have gotten through a year politically. You have another 5 months to go in this particular budget. You could make some changes, but you have 27 and 28 before the boom. And you've got to make up your mind what you are going to do to leapfrog so that you are in an advantageous position for self-sustainability. and for best use of that financial windfall when it comes in 2028. And that means you have to take decisions now and do things now, do them dedicatedly to meet certain objectives before 2028. So we can't wait for 2028. We can't mark time. We can't worry about what we inherit. We have to do something. And my best advice today to the government is to get going, take the India, expand and intensify the diversification process and investment in tourism, manufacturing, and agriculture, and related things like culture, the natural asset base, etc., so that we could make some money. But at the same time, begin to unleash throughout the country and throughout the system the digital stack that India has provided, and begin the connectivity process with CARICOM. And let us be in a position to capitalize on the oil boom in 2028. Thank you very much.
Thank you, Dr. Tawari. I know that the other speakers and our audience here today is definitely agreeing with you in terms of the leapfrogging, the innovation, and ensuring that there is a sufficiently strong platform for non-energy growth. At this time, I want to hand over to Professor Hussein.
Hi, everyone. Good night. Rebecca, are you hearing me?
Yes, Prof.
Yes,
We
good.
are
Can you
here.
allow me to share screen?
Yes, you are allowed.
Okay. I won't be long. Most of the previous speakers said, I just came on to use 2 slides actually. So the first slide I would say is this relationship between transfers and subsidies and labor force participation rate. I mean, I heard Dr. Conrad's comment on the labor force participation rate, and I have done a lot of work on the labor force participation rate, and I can tell you the contraction in the labor force participation rate is strongly associated with a slowdown in growth. If you have a significant chunk of your people who are not participating in the labor force, be it that they are in gangs or whatever they're going to, then obviously that's for each person that is not participating, you lose that per capita contribution they would have made in terms of a worker, and that and here it is. I show the perverse relationship. I looked at some of the data. It's just very preliminary right now. So real GDP is marked to grow, slow growth, low growth, not something that we could jump about in 27 and 28 and 29. We expected to increase. The inflation rate, it's reasonably expected to be low. And the good thing about the inflation rate, Rebecca, if you watch here for 2024 and 25, are you all seeing those highlighted numbers?
Yes, Professor.
You will see that the good thing is it dampened the, I wonder if I can highlight it in anyway. No, I can't. You are seeing that the real effective exchange rate actually contracted now. That's one of the biggest gains I've seen for the economy in a little while, that contraction in the real effective exchange rate, which will give the manufacturing sector a little hope. Apart from that, though, it continues to be a situation where persistent fiscal deficit. And what I have noticed, Dr. Gookool, is that interest expenditure has, in trying to be good, is now superseding capital expenditure. Not good. Not good. You want to be spending your money on widening productive space. Public sector debt continued to rise. The HSF remains at more or less the same level. When you talk about gross official reserves, though, you must mention external debt, which is now are about 1.3 billion US dollars above reserves. In other words, if we had to pay all our debt in the morning, we wouldn't be able to. Our reserves is now superseded by external debt by about 1.3 billion. Some good news in tourism, it has shown some sign of increasing. And as I said there, the real effective exchange rate has moderated and a gentle increase in real per capita GDP. All of those things are good. And I heard people speak about Dragon and Manatee and all those things. And, you know, it's really good if we get this extra gas. I saw Indira put some numbers. When I work the numbers, it's taken us to about 3,600 by 2028. If Dragon doesn't come on stream, I would only count Dragon when, there is more certainty. The big challenge for me in this country and the big stumbling block I have and the real concern with long-term sustainable growth is this variable here, Dr. Gookool, non-energy exports. This variable was forecasted to reach to increase US 5 billion by 2030. My understanding of these things is that for 2026, when we get the number, and we should get that number by next week, Wednesday, 2025 overall annual non-energy exports will be probably less than 2024. So in other words, on this road to a 5 billion US increase in non-energy exports by 2030, we are starting off with a fall, which means that to reach the 5 billion increase, we would have to go to about, let's say, 5.5 billion. That's not an easy target. It's not an easy target because, one, the real effective exchange rate, as you would see here, Dr. Gookool, are you all seeing this 126.2?
Yes, Professor.
Yes, we see that.
Right. Although it fell a little bit from the 128.4 to 126.2 approximately in 2025, what that means is it's still 26.2% appreciated. And with the changes in the gas prices that is feeding into the manufacturing sector, we have to and with the inflationary impact of the war, we have to wait to see how the relative inflation rates between ourselves and our main trading partners work out. But that's likely to go to about, I am going to guess in 2026, about 129. So you have an overvalued exchange rate and you are trying to catch up with non-energy exports. That's going to be very, very difficult. And also, if you look at these numbers here, you would see me mention tourism. I'm sure I mentioned tourism somewhere here. Dr. Gookool, this number here is 379,000. But for us to reach anywhere of the type of energy revenues we got in 2022, 50% of that. So we want 50% of the energy revenues we got in 2022 to have some degree of stability from the tourism sector is where we want it. We have to increase this to 3 million tourists. I've worked out the numbers. And so we have to multiply this by almost 9 times. That's a long way to go. And so I urge the ministry, in my opinion, with the real challenge of saving the Trinidad and Tobago economy is the Ministry of Trade. Trade and MITI. And I am saying that the quantum of work, and I am sure they are doing a lot of works behind the scene, but they are not communicating the strategy adequately, in my opinion, to the public. For example, I wonder if they are aware that most of the improvements I'm not dwelling on these graphs, I'm just showing it here just to make a point. What's the time? The time is, I will take 1 more minute. I will take 7 minutes overall. The number of areas with comparative advantage increased between 2013 and 2024, but it had nothing really to do with extra-regional trade. It was really because of intra-CARICOM trade. I looked at the numbers, and therefore we need to strengthen intra-CARICOM ties because we are in a very fragile situation in terms of the need to grow our non-energy exports. My graph just disappeared. Did you stop it, Rebecca?
I am not sure, Prof.
Anyway, it's okay. I will field some questions. I didn't want to use up too much time. I have half a minute again. All I would say is that the medium-term outlook looks much brighter because of Manatee. and because of the possibility of gas from Coquina and Manakin and Dragon, fine. Note that there is a continuous depletion of our natural gas production because of maturing fields. And all I would say is that the road ahead, given a labor force participation rate of 54.8%, a murder level that is still running close to 1 a day, an appreciated real effective exchange rate of about 26%, a contraction in non-energy exports in 2025 when we anticipated probably a 800 million to 1 billion increase, a level of tourism at 379,000 as compared to where I think we should be drifting towards 3 million. It's a long road ahead. It's a narrow road. We have a lot of work to do. And I think that the ministry that has to lead this charge is the Ministry of Trade. And they need to educate the population some more on the mechanism and the avenues they are going to use to increase non-energy exports to 5 billion by 2030. So what I will do is I would stop there, and if there are any questions, I will take them in the question and answer session.
No problem, Professor Hussein. Thank you to each of our presenters for complimentary, excellent discussions. I want to ask Dr. Conrad and Dr. Sajwan to unmute your mic and put your cameras on, and for audience to raise your hand should you have any questions so that we can chat with our experts this evening. We can take one round of questions in the interest of time. I see Mr. Mustaq Mohammed.
Yes, I have a few questions, and it's probably for Professor Hussein more than anyone else, right? But anybody free to answer. But a little bit of commentary first. So quickly, I still believe we're not seeing the whole picture together, and I still believe we're fundamentally weak. We haven't considered the risk to the economy, which is our 6.5 months cover could go very quickly if the American economy slides. We are in stocks and bonds, so we have to be very careful. We also have to watch the impact of subsidies growing because of the increased price of fuel to the country at $120 a barrel for oil. Our subsidy is probably going to grow past $1 billion unless something is done, which is going to cause even more spending. So there are fundamental structural weaknesses that we must consider when we say we kind of stable. I don't believe we are stable as we are. Dr. Tiwari spoke about hydrogen, and that's a passion of mine. We have one of the biggest markets for hydrogen in this region, probably in the Western Hemisphere. And we have the opportunity to produce green hydrogen. But these projects just take too long to come to maturity for whatever reason. There's one project now that is almost in field that is struggling. Years and years have been passing. No decision. And that is actual money, foreign exchange going to the country, direct foreign investment, and it allows you to sell your gas for LNG that makes more money. But back to manufacturing. Professor Hussein, I fundamentally believe that we are measuring the same things over and over, and what we are measuring is the wrong things. And you and I as friends, I could talk to you as I like, right? So bear with me. Development, we're not measuring capital spent on innovation. How we know what is the capital that is being spent on innovation to create new production, new efficiency, new systems that make us more competitive? If we don't measure that, we don't have an idea where we're going. And what we call manufacturing probably is still not manufacturing in terms of the real sense of creating and innovating products to meet the demands of new markets. So we don't measure that. We don't measure developmental capital. We don't measure capital that goes into new projects, new ideas, new systems. We have no way of measuring that. That doesn't fit into our economic picture, which is critical for development of new ideas, new systems, new manufacturing technology, new processes that makes us more competitive. Maybe we measure net foreign exchange earned from manufacturing. Maybe the exchange rate in terms of what we buy and what we sell we still probably spending more on the things that we buy than the things that we sell. So I think one of the advice to the Ministry of Trade is get the right metrics to measure the performance of the manufacturing system. If we keep on measuring the same things we're measuring, we're not going to go forward. So we need some thought around that, and that's basically my contribution. What are we measuring to know that we're driving the manufacturing sector forward?
Thank you so much, Mr. Mohammed. Panelists, do you guys want to take those questions in rounds? What we can also do, whoever is taking the questions, we can start the round of wrap-ups as we move on.
Rebecca, I see Dr. Conrad has to go, so let him go first now.
No problem, Dr. Conrad, go ahead. You are
I really
muted.
didn't have any comments to add to what was said by the gentleman just now there.
No problem. Would you like to do your wrap-up?
Well, you think you'll be running substantially over time, or? No,
We
but
have 4 minutes
okay.
again.
Okay, I just think that it's a good discussion, and I think that we have, as highlighted, we have some concerns. We do have some inherent structural weaknesses, and we also know that this sort of stability that we're looking at is a sort of soft and fragile stability. So we should not say mission accomplished by any way, shape, or form, but meaning that it gives us a little bit of space to begin some sort of meaningful efforts to sort of boost a more broad and deeper recovery post-pandemic, bearing in mind that we have external shocks that at any minute can erode any gains that we would have made over the past few months. Thank you.
Thank you so much, Dr. Conrad.
Rebecca,
Dr. Til,
yeah.
go
Oh,
ahead,
so
Dr. Tajwa.
I'm happy to go maybe to respond to some of the issue and for my wrap up as well.
Sure.
I think the one thing that ran through the panel, Mr. Mohammed, is the fact that we let us first understand that this is a mid-year review. We came in order to be able to assess new government. They only started, they've been in office for a year. They read a budget 6 months ago, and what have they done? What have they done good? What have they not done so good? So I think we need to first kind of put in context what the discussion surround what it was around. And I think what ran through all the presentation is the fact that we're saying they were able to bring some amount of stability to some of the economic variables, but the stability is extremely fragile. So we recognize very well what you're saying, that the 6 month import cover could be wiped out like nothing. But in the same way, we could enjoy some potentially some stronger revenue stream because of what's happening globally with respect to the price of oil and the price of gas and petrochemicals. It could, be on our best. So it works in all the different ways, and I'm totally in agreement with you. One has to be extremely mindful. The government has to be extremely mindful in terms of how fragile the economy of Trinidad and Tobago is, which really strengthens the point that I think I made, that was strengthened particularly by Darren and the both the other speakers, is that in this moment the government has to be mindful not to get carried away with the windfall that seems to almost definitely be coming from oil and gas. I also want to make the point that even though we may see the volumes revert to the 2014 volume of the 4,200 1,000 BCF, we're not going to get the same amount of revenue inflows because there's not going to be royalty coming in. This is gas. A lot of it is gas from Venezuela. So what we are going to get is largely through taxes, etc. We also have to take into account the fact that many of the investments, there might be opportunities for tax write-offs, so that it is not necessarily, certainly in the first set of years, going to bring the kind of revenue we may generally associate with the volume of gas, because it is a different mechanism through which it is now going to be flowing to us. The issue of innovation and how we measure things, we must always be we must always be shifting and adjusting to what we do analyze. I want to say though that there are elements of the manufacturing sector in this country that are operating state of the art in terms of technology, in terms of what they have on offer. I mean, recently we ran a WTO training, and I took the regional participants to Blue Waters and to SM Jalil. And you know, the persons from Switzerland were saying, my God, you know, what they saw here was basically cutting edge in terms of what they are seeing elsewhere.
They
So
need
that,
more.
yeah, so there is some of that. There's some happening. And there obviously there's a room for a lot more to happen. But I want to end my thing by saying, you know, while I agree that we have to always be forward looking, I want to say that there are so many in trying to be overly forward looking, we run the risk of allowing what to me are very low hanging fruits around us to go untapped. We're a tiny little island with constraints, and I feel very strongly that things need to be done simultaneously. So yes, there's been significant effort at oil and gas. I mean, a great effort within 1 year, the amount that we have seen happen there. I want to see that same kind of effort and drive targeted towards tourism, towards manufacturing, towards the other sectors, employing the things that you have mentioned and talked about, and employing the things that Dr. Tiwari in particular mentioned in terms of the importance of digitization and all of those things. So I think there's a lot, and I think we're all in agreement with that. There's a lot of work to be done. Whether it is being done, I don't think any one of us sitting here actually knows. We know the targets that have been put forward. We know $5 billion in non-energy export earning in 5 years. We know $3 billion in investment in the tourism industry in 2 years, $9 billion in 5 years. We know increase in export, agricultural export by 1 billion 2026, 2027, to be doubled in 2028. Those targets are in front of us. It is the how those targets are to be achieved, which continues, in my view, to be a well-kept secret within the government. And I agree with Roger very strongly that we need to see the rollout of those plans that can translate these that can realize the goals that have been set. So that to me, thank you very much, Rebecca. I remain hopeful in this moment. I don't know if that will change, but I remain hopeful in this moment that we could potentially be heading in the right direction. It may change next year, but that is how I feel in this moment. Thank you very much.
Thank
Thank you
you,
for allowing
Dr.
me to participate.
Sajwan. Dr. Tiwari, would you like to chime in at this time?
Well, I don't really have much more to say. What I would say is that a year has gone, a little under half of this fiscal year remains. There are little shifts that can be made that could make a difference, and we should do that. But there are big initiatives that we must take with great collaborative effort and great intensity, because they really have to do with our survival and sustainability. It would be a mistake to wait for natural gas money and to spend it on the debt and the expenditures and the increases that we incur now. And therefore, I would not like to see that happen. I would like to see this boom, whatever it is. And Indira was cautious. She said we might not realize the level of revenue that people might be thinking of because of the structure of the various investment agreements. And I think that is something we should also bear in mind. But my own feeling is that we've got to do a lot of things here. The The shift from public sector to private sector must happen. The private sector non-energy investment must happen now to make a difference next year and the year after. The infusion of AI and digitalization must take place now for the oil money not to be stuck in 15,000 gatekeepers in the public service that are pushing paper. Unless we do the technological leapfrogging that is necessary now, we're going to find out that money coming in swift and fast will simply be squandered, as it has been on many, many occasions before. So I think now that we have a little more sense, now that we know a lot more, now that we have a lot more experience, now that we know the mistakes that we've made, now that we see what are the good examples that other countries have done, and now that we have a choice as to how to proceed, I think we should make some judicious choices about the future of our country and not let our 64 years of independence go to waste.
Thank you very much, Dr. Tiwari. Professor Hussain?
Rebecca, I shared my number because I think I know you wanted to finish at 8:36, so people could, if they have a question, they could ask, and I would direct the question to Indira or Dr. Tiwari, as the case may be with the person's number. I think in closing, I would say it's a long road ahead. So what I would give Minister Tanku some credit for is keeping the ship reasonably steady in rough waters for this year. He didn't inherit a bed of roses. And yes, the bottom has not fallen out of the stock of reserves. I saw Mustak ask a question. Mustak, what I would say is if you take external debt out of reserves, though, our import cover is negative. So it has an artificialness in it there that I don't want to elaborate now. All I would say is we need to row in the same direction, and we need to avoid any changes in fiscal expenditure in the coming year that would boost recurrent expenditure unnecessarily. It is time to give capital deepening a chance to help us to change economic outcomes, especially on the non-energy export side. Thanks.
Great. Thank you so much. And thank you to each one of the panelists who has brought excellent information as per usual on this platform tonight and have been very open and engaging with their expertise. So to everyone and to the organizers of this session, thank you so much. Thank you to all of the audience who remained with us past our designated time. Please look out for our next conversation. So have a pleasant evening, everyone. Bye.
Thank you.